Hey everyone, and welcome back. Today, we're tackling one of the most powerful, yet often misunderstood strategies in the US investing playbook: tax loss harvesting. Most investors see a loss in their portfolio and cringe, but smart investors? They see an opportunity. Done correctly, tax loss harvesting allows you to transform those temporary paper losses into real, immediate cash savings on your tax bill, effectively boosting your portfolio's performance without taking on extra risk. We're going to dedicate the next few minutes to breaking down this entire process. We'll cover the core concept, the critical wash sale rule that can instantly ruin your savings, the step-by-step process, and how to execute this strategy using common funds. This guide is your complete blueprint for making your taxable brokerage accounts work harder. Let's dive in and start saving money. So what exactly is tax loss harvesting? It's a simple yet brilliant strategy. It involves selling an investment that has lost value, a loser, to realize that loss, and then immediately buying a substantially similar but not identical investment. This keeps your portfolio's asset allocation and your exposure to a potential market recovery. But why do this? Because that realized loss can be used to offset realized capital gains you made from selling other investments, your winners during the year. Imagine you sold a stock for a $10,000 profit, but you also sell a different investment for a $10,000 loss. Your net capital gain is zero, and you owe no capital gains tax on that profit. It's like a financial magic trick. And what if your losses are greater than your gains? Even better, you can claim up to $3,000 of that excess loss against your ordinary income, like your salary, each year. Any loss beyond that can be carried forward indefinitely to offset future gains. This is how a temporary dip in the market becomes a permanent tax benefit. It's crucial to remember, though, this strategy only works in taxable brokerage accounts, not your 401(c)(as) or Roth IRAs, since those accounts are already tax-advantaged. Now, before you rush off to sell your losers, we need to talk about the single most important rule in this entire game: the wash sale rule. If you violate this rule, the IRS disallows your loss, and this whole exercise becomes pointless. The rule states that you cannot claim a loss if you or your spouse buys a substantially identical security within a 61-day window, that's 30 days before you sell the day of the sale and 30 days after you sell. The key phrase here is substantially identical. If you sell the Vanguard Total Stock Market ETF VTI to harvest a loss, you can't just buy VTI back the next day. You also can't buy its mutual fund equivalent, VTSAX, because it holds the exact same underlying stocks. However, what you can do is immediately buy a non-identical replacement like ITOT, which is the iShares Core S&P Total US Stock Market ETF, or SCHB, the Schwab US Broad Market ETF. These funds are generally considered different enough because they remanaged by different companies and track slightly different indexes, even though their performance is extremely similar. This subtle difference is what makes tax loss harvesting possible. Breaking the wash sale rule is a common and costly mistake, so always pick a replacement fund that tracks a different index. Alright, let's walk through the exact steps to execute a perfect tax loss harvest. It's a simple 3-step process. Step 1. Identify your losers and winners. Go through your taxable account and find any investments that are trading below what you paid for them. At the same time, get a clear picture of your total realized gains for the year from anything you've sold at a profit. The goal is to harvest enough losses to offset those gains, plus an extra $3,000 to deduct against your ordinary income if possible. Step 2. Execute the swap. This is the main event. Sell your losing security to lock in that capital loss. Then, immediately, and I mean in the same minute, use those proceeds to buy your pre-selected replacement security. For example, you sell VTI for a loss, and you immediately buy ITTOT. This swap is critical because it keeps you invested in the market so you don't miss out on any potential rebound, all while securing your tax benefit. Step 3. Track the holding period. After you've sold your original security, you have to wait at least 31 days before you can buy it back. During this waiting period, your replacement fund, ITOT in our example, keeps your market exposure intact. After the 31 days are up, you have a choice. You can sell the replacement and buy back your original fund if you prefer it, or you can just keep the replacement. The choice is yours. And here's a quick pro tip for mutual fund owners. If you hold a mutual fund like VTSAX, the process is slightly different. You need to sell VTSAX, but because mutual fund trades only execute at the end of the day, you should buy an ETF like ITOT as the replacement. ETFs can be traded instantly during market hours, ensuring your swap is clean and you don't spend any time out of the market. So, when is the best time to do this? While you can harvest losses anytime the market takes a dip, most people do it near the end of the year, usually in November or December. This gives you a clear view of your total gains and losses for the tax year, making it easier to plan. Another key benefit of tax loss harvesting is that it resets your cost basis. When you sell for a loss and buy a replacement, that new purchase establishes a new, lower cost basis. If the market then rallies, your future gain on that replacement security will be smaller than the gain you would have had on the original. And if you hold that replacement for over a year before selling, any profit will be taxed at the lower long-term capital gains rate. Now, there are times when you should not harvest losses. First, if you're already in the 0% long-term capital gains tax bracket, harvesting a loss provides no immediate tax benefit. For many low to middle income folks, long-term gains are already tax-free. In that case, it's probably better to just hold the asset and let it recover. Also, remember that investment returns always come first and tax savings come second. Never sell a security you fundamentally believe in just to realize a small loss, especially if you have no capital gains to offset. Tax loss harvesting is an incredibly valuable tool for any investor with a taxable account. It's a way to get a small, government-approved subsidy on your market losses, putting cash back in your pocket right now. By understanding the core concept, respecting the wash sale rule, executing a clean swap, and timing your moves correctly, you can master this strategy and make your portfolio even more efficient. Thank you so much for watching. If you found this guide helpful, please hit that like button and be sure to subscribe for more content to help you become a smarter investor. See you in the next video.